Welcome back, traders. Precious metals suffered one of their most aggressive declines in decades, with gold losing more than 20% from an all-time high of almost 5,600. And the next question now is whether that sell-off will continue the coming sessions, as the US calendar includes important data releases such as the US non-farm payrolls report, ISM business PMI figures, as well as a couple of Fed speakers who will be on the wires during the week. And central bank meetings will also attract attention. The Bank of England's rate decision will be out this Thursday, while Japan's snap election is scheduled for Sunday. So any remarks from Japanese officials could also cause volatility. So at this video, I'm gonna analyze gold, USDJPY, and pound dollar. And now let's start first with gold, which suffered one of its most painful sessions. And that decline happened after President Trump nominated Kevin Warsh as the next Fed chairman. He's not a very ultra-dove policy maker, so that caused some questions about how dovish the Fed could become in the coming months. Meanwhile, the Chicago Mercantile Group has increased margins on precious metals, while a sell-off on Wall Street might have also caused some liquidity in precious metals. Probably traders tried to offset their losses by selling precious metals, and that has also probably weighed on gold. Now, from a technical perspective, I would rule out more weakness, as the technical indicators down here have yet to reach oversold levels, so perhaps bearish pressures could remain in place in the coming days. Nevertheless, it's important to note that the precious metal has hit key levels. It rebounded just near its October high of 4,380, and it managed to return above the 50-day moving average. So that suggests that upside pressures haven't actually completely faded out, while the broad bullish trajectory is still in place. So that correction over here might be tested in the coming days. In the time being, the 4,690 and 4,780 region will be closely watched. We can see that there is a former key resistance line, which is currently acting as support. And now what we are waiting for is a clear close above the 20-day moving average around 4,780, and if that happens, if we close above that line, then then the precious metal may approach again the 4,900 and 5,000 levels, a break of which could take us back to the 5,180 level, and then probably, if more gains follow, the 5,420 mark could come back into view. Now, on the downside, if the precious metal continues to decline, and perhaps such a scenario could take place if, for example, US non-farm payrolls come out higher than expected, probably questioning further easing further monetary easing in the coming months. So in this case, we could see the price falling back to the 4,480 region, or even reaching the 4,380 territory as it did back on earlier today. Then additional declines from here could meet the 4,250 level. That was also a key constraining zone back in November and December, while that area also acted as a key pivotal region that caused that sharp bullish wave towards the all-time high of around 5,600. Now looking at USDJPY, well, the pair is exposed to the US non-farm payrolls report, which will be out this Friday. Expectations are not great. Analysts expect an increase of 64,000 in jobs, a steady unemployment rate of 4.4%, while average hourly earnings could ease slightly. So it will be overall a moderate increase in jobs. It won't be a very bullish release. Nevertheless, any surprises could cause volatility as the Fed will face a new chairman from May onwards when Powell resigns. And of course, the key question is whether the Fed will, how many rate cuts the Fed will deliver in the year ahead, and whether Kevin Warsh could become an ultra-dove policymaker, or whether he will resume, or whether he will retain his traditional hawkish mood. But conditions are different now, so expect and divisions from previous behaviors. In the meantime, USDJPY is not out of the woods despite its recent rebound. It's still constrained between 154 and 154.80. And I would like to see an even stronger bullish action above 156.15, where the 20 and 50-day moving averages are converging in order to target higher levels such as the 157.50 level, and then perhaps if there is some more, if there are more gains above this region, we could reach the constraining zone of 159, where the price peaked back in January. And now, from a technical perspective, we can see that there is some positive sentiment in the market. The RSI and the stochastic oscillator have turned up. But the RSI is not hasn't actually risen above 50. The MACD down here is still a negative region, so probably downside pressures may persist in this market. In the case that the price falls below 154, I expect the 152 region to act as support once again. While lower than that, the 150.85 territory may also attract attention, as this includes this key support trend line from April 2025. So any failure to pivot here may confirm additional declines, and if the price extends below the 50% Fibonacci retracement level of this up leg at 149.70, then we may see a sharp decline towards the 61.8% Fibonacci mark of 147.35. And finally, looking at pound dollar and the Bank of England's rate decision, well, analysts expect the central bank to keep interest rates steady near 3.75%. But what would be quite interesting is the voting structure, as expectations are for only 2 policymakers to vote for a rate cut compared to 5 during the previous policy meeting. So it would be quite interesting to see if indeed that scenario plays out. What's the reason behind this change in sentiment? Perhaps inflation could play a big role as it remains elevated, but on the other hand, the unemployment rate is also at a near 4-year high. So it will probably divisions could come into play among policymakers. But let's see whether the central bank will prioritize its inflation goal, as tariff threats from the US could become possible after the US president criticized the UK stance to strengthen its ties with China. In any case, while I expect a cautious mood within the central bank, probably a data-dependent approach could be applied this time, which could keep pound dollar supported. As we can see, the price is currently trying to find support near the 23.6% Fibonacci retracement level of the up leg that started back in November. That follows Friday's sharp decline, which caused some caution within the market. But if you look at the technical indicators, and particularly at the RSI, the indicator is still comfortably above its 50 neutral mark. The MACD is also above its red signal line, so we don't actually have a clear bearish bias. Well, for selling pressures to strengthen, probably we need a sharper decline below the 1.3665 and 1.3650 level in order to target the 20-day moving average near 1.3540. The 38.2% Fibonacci mark is also within this region. And then below that, all the attention will turn to this support trend line at 1.3415. The 50% Fibonacci is also within the same region, so along with the 50 and 200-day moving averages. So failure to rebound here could actually dampen market sentiment, confirming additional declines. Now, in the event of a rebound, traders could still remain cautious as long as the price stays below the 1.3815 and 1.3840 region. If we break that, if there's a successful break above this wall, then we could head towards the 1.39 and 1.3950, and then additional gains from here could target the 1.40 psychological mark. So that's everything I wanted to share with you guys. Thank you for watching. If you liked my video, please subscribe to this channel for more technical updates. We'll be back on Thursday for more market analysis. So thank you for watching and see you next time. Bye bye for now.